Hi, friends. Welcome back to the Skinny on Wall Street with us, the Wall Street Skinny. I'm Kristen.
I'm Jen.
And today is going to be a quick episode. Jen's going to be doing the bulk of the talking today. But we're going to get into, there was some news about Citadel last week, which I'm not going to lie, Jen, like I didn't actually read the article you sent because I was like,
It's
you're going to
okay.
explain
You
it to
know
me
that
anyway.
I barely listen to like half the podcasts you send me. I listened to the first 5 minutes. I'm like, I listened to it. Did I complete it?
The
No.
one that I sent you recently, because we're interviewing two of the guests coming up. So that's why,
Yes. Yes.
So we're interviewing Ted Seides and Jen Prosek, and they were on a podcast together. It was on Ted's podcast, Capital Allocator. So anyway, I thought it was interesting, and so I sent that over to you. But no, so today we're going to get into, again, some news about Citadel, which if you've never heard of them, go back and listen to our episode with Ashish Goyal, because it was like my all-time favorite episode of all time. He worked at Citadel, but basically they're a hedge fund, they're a pod shop. And I guess there's like some crazy trading shit going on there. So Jen, do you want to walk us through exactly what Citadel's doing?
When you explained what Citadel is, I think that's actually a common misconception that people have about Citadel.
Oh.
So there's Citadel, the hedge fund, and there's also Citadel, the broker-dealer. So Citadel is a broker-dealer just like Morgan Stanley, Goldman Sachs, JP Morgan, Wells Fargo, Citi. They have effectively a sales and trading arm. They have a sales team. They have market makers, right? Just like a lot of the high-frequency trading shops like Jane Street are market makers. Citadel is not trying to be anything else in that arm of the firm. They truly are a regular old sales and trading shop, but they're not attached to an investment bank. So I want to back up a step. I'm really glad that you actually introduced them that way as a hedge fund, because that's how so many people think about them, but they are so much more than that. And that speaks to the complexity and the dynamic that's happening right now in the market making world. And that's what we're going to talk about. So most of you know, and if you're new here, welcome, but most of you know that I spent the majority of my Wall Street career in the fixed income division of an investment bank in what's called sales and trading. So I covered institutional accounts, whether it be hedge funds like Citadel or other players in that space, specifically for interest rate products. So US Treasuries, swaps, options agencies, some mortgage and credit stuff, whatever. Now, when we, and by we, I mean me and Kristen, talk about sales and trading, the majority of our conversations revolve around fixed income sales and trading. And we often gloss over the fact that just about every single Wall Street broker-dealer also has equity sales and trading. They have a whole other division that we rarely ever talk about. We talked about it once with Guy Adami. We've talked about it. We touched on it briefly with our friends from Benjamin Talks. We haven't really done a deep dive into that segment of the firm, and we will. But part of the reason we don't talk about it as much, aside from the fact that like that's not where our personal experience was, but the reality is that the money that most banks generate through their equity sales and trading business, it has been steadily declining over the last 2 decades.
And that's become like a commodity. I mean, it's like less exciting than a commodity. Like commodities, you can like actually make a lot of money. Like, I'm not sure. I mean, I'm sure you can make a lot of money in sales, but I don't know anymore. Not at like the within sales and trading proper. Again, I don't know.
And just relative to the fixed income division, there's less opportunities to add value for clients in a way that justifies high fees. And so that fee compression has resulted in a bit of a brain drain and just a compression of the business overall. And again, I think that's something that we definitely are due to get into and will with an expert.
Well, and I wanted to say, we are going to get our friend Dan Nathan on to talk options, because I do think when you get into some of the derivatives, it gets a little bit more interesting. And when I was working in converts, like we did a lot where we would help companies manage risk by buying call spreads and like all these different kind of things. But again, like that was actually more in the capital markets realm. It wasn't even in like the sales and trading side of the bank. So I am curious. I am really excited to get into the derivatives, but like pure vanilla, I don't know, equity sales and trading. It just feels like, I don't know. I mean, it doesn't seem that exciting, but maybe I'm wrong. So we do need to get someone on. And by the way, if anyone's listening and you are working in sales and trading and you can come on and tell us we're wrong here, like we welcome you. So.
Right. But just from a headline standpoint, it is no longer among the biggest drivers of value for investment banks as a whole. And some of that fee compression and brain drain has been happening to some extent as well in fixed income sales and trading. I mean, I always talk about how tragic I find that like voice execution has largely fallen by the wayside because of things like electronic trading, like you talked about,
Can
the
you explain what voice
commodification of some of these.
execution?
Yeah,
Can you just
sure.
explain
So
what that is?
what literally would happen is a client would come in to do a trade and they would call me on, I had a board of lines that were direct lines to some of the world's biggest asset managers, hedge funds, other bank portfolios, things like that. They would call and they'd say, hey, make me a two-way on 100 million 10-year notes, or where would you offer 500K in '01 of 10-year rate, or where would you bid 100K in '01 of 2s 10s rate switch, things like that. And I would be responsible for delivering that inquiry in a specifically coded way to the desk that maximized the desk's opportunity to make money and minimized the chance that there was an error, and also made the client comfortable that they were getting the best, the fastest, and the most kind of confidential and secure execution as well. So it was a juggling act, relaying the desk's pricing to that client, making sure that everything went as smoothly as possible. And what's happened over the years is most of this happens now electronically, and multiple dealers will be asked to quote the same thing for a client. So they'll be able to go to 10 dealers simultaneously and say, where would you bid this, offer this, make me a two-way, et cetera, et cetera. So that's just one example of how things have changed. And you just don't need as many salespeople in that case who are really talented at jumping up and doing this, right? They have to be talented in other ways. But there has also been a little bit, and we can argue what year, to what extent, maybe not. This isn't always true across the board, but there has been some reduction in revenues at the fixed income sales and trading level as well. But that's driven more by regulatory changes rather than just a total wholesale shift in attitudes towards the product. There has been fee compression and bid offer compression as well, absolutely across the board. But what I really want to get at here is, I think it was a month or two ago, we talked about Basel III Endgame and bank capital requirements. In that specific instance, we were talking about how banks were effectively outsourcing balance sheet to the drastically less regulated world of private equity firms as a workaround for all of the onerous capital requirements that have been stacked upon them. And just to remind you guys what that means in plain English, but for every asset, meaning every loan or investment that the bank makes, it has to hold a certain amount of liquid capital against it on a risk-weighted basis. So if I'm a bank and I want to lend money to Kristen, the government's going to tell me, based on the riskiness of that loan, that I need to hold a certain amount of what's called tier 1 capital. And I don't have a list in front of me, but I think it includes reserves. So reserves are deposits I don't lend out, common stock, I think some types of preferred stock. And Kristen, you'd probably know how all that works better than I do.
Not really, but I will say that one of the things that happened during the Great Financial Crisis, so in like 2008, and actually leading up to the Great Financial Crisis, is a lot of banks had to shore up their tier 1 capital. So they had to do a lot of equity raises. And at the time, nobody, like, who wanted to invest in freaking financial institutions, which was why you saw a lot of banks go out and raise converts, because then you would get that tier 1 capital. Like the structure of it, like they had these different structures, be like mandatory converts, convertible preferred. And the moral of the story was like, it actually led to a shit show, because a lot of the people that invested in that were hedge funds who were trying to delta hedge. And then there was this no short selling ban. So basically like a whole bunch of convertible arbitrage hedge funds blew up. So it was not a great thing. But the point is that, yes, they had to essentially like raise equity capital to shore up their tier 1 equity at the time.
Right. So all that was, 15 years ago. And the government is like still trying to figure out what it should look like today to prevent that from happening now. And all you really need to know at the end of the day is that as a bank, I've got to be very judicious with how I deploy my balance sheet. And when we talk about balance sheet, I've got my assets and my liabilities. My assets are the things that I own. My liabilities are the things that I owe. And so what do banks really use their balance sheet for? And we obviously understand how banks make their money in terms of like, hey, we take in deposits, right? And we lend out money at very low rates. And then we make long-term loans and we lend that out at theoretically higher rates. But they use their balance sheet for a heck of a lot more than just their commercial banking activities, okay? They use it for sales and trading. Buying and selling bonds or entering into derivatives contracts even though to a lesser extent, it takes up balance sheet. Okay.
Right.
So facilitating the borrowing and lending of securities and cash for clients who are also then in turn borrowing and lending securities and cash. That all takes up a ton of balance sheet. And we've talked about this before in other episodes, but it's worth repeating here and going through an example of how that works. Okay.
Yeah.
So if I have $1 billion hedge fund and they want to take a relatively small position in a relatively super low credit risk security like a US Treasury, and they want to make a very small bet on whether or not the Fed is going to ease or hike rates sooner or later than expected, something like that, right?
Yeah.
Again, $1 billion hedge fund. If they want to compete with all of their buddies out there, they're aiming for some really juicy returns on that, okay? They want to return maybe 10% on that fund, 20% on that fund, right? So let's say they're making a bet like, I don't know, I think that 2-year notes are going to move 10 basis points based on this change in the Fed. And I feel confident enough about that to put that on to the tune of, I'm going to make $100,000 for each basis point. So I want to make $1 million on that trade. Okay. That's not going to make a dent in the return on $1 billion fund, right?
Right.
The size I would need to do that in 2-year notes is something on the order of over $500 million in 2-year notes. I would need to buy or sell something like 555 million 2-year notes. And I don't have like these numbers secretly in front of me. I've done this enough times to know that's just about the number, like give or take 50 million, right? Okay. So I really want to repeat that though. In order to take out a relatively small position, it would be over half of the capital in the entire fund. Okay. So no one's doing that, right? So what do? They go out and they either borrow $500 million in cash from a bank and pledge the bonds that they then buy as collateral for that loan.
Right.
Or if they go short, they borrow $500 million worth of bonds from the bank, they sell them, and then they lend the bank the cash that they earned from that sale. Okay. And these processes are called repo or reverse repo trades. It stands for repurchase agreement. That is how institutional clients like hedge funds, like the hedge fund side of Citadel, that's how they get all that leverage. All right. So back to where we were. We're talking about capital requirements for banks. Okay. In a regulatory environment where every last dollar of a bank's balance sheet is like precious AF, it becomes really difficult for both clients and banks alike to trade those products, right? There's less liquidity for the clients and the banks can make less money because they can't take as much risk and they can't facilitate as many trades to earn bid offer spread, right?
Yeah.
So it becomes this whole vicious cycle, really, where the regulation to make everything safe makes markets less liquid. And then we have to wonder, like, does more leverage make the system safer or whatever? We can have all those discussions in a theoretical way. But here's what this Bloomberg article stipulated. They said that Citadel Securities, which is, again, not tied to an investment bank, so not regulated in the same way that these investment banks are. So the broker-dealer side of Citadel, which is still, they still have to follow like SEC regulations, right? Like they're just not the Wild West, but they don't fall under these bank capital requirements. The rumor is that they are going to offer their sales and trading services as basically like a white label function to these investment banks so that they could outsource their sales and trading operations without having to use up all this balance sheet and be subject to these capital requirements. So I think that's a really interesting potential step in the evolution of the entire institutional environment as a whole in the role of Wall Street. And we know, I keep meaning to, we have a lot of friends who work at Citadel. If you're listening, I'm talking to you. People who I pinged and saw months ago who I said, come on the podcast, and I actually need to follow up with you. But hopefully we'll have someone from Citadel on here to talk about that. And who knows if this will ever come to fruition. But just like we talked about what banks are doing to circumvent those capital requirements by outsourcing their balance sheet to private equity and private capital for making loans and all of that fun stuff, thinking about what the next iteration of that might look like for the sales and trading division. Again, what I was told was there was something like, I forget what the number is. I think the acceptance rate for Citadel Securities for, we heard about the acceptance rate for Goldman Sachs' summer analyst program. I've heard that it's like another order of magnitude more competitive.
I'm sure.
even for deaths outside the United States, right? For deaths that like no one's even heard of. So I just
by the
think
way,
that
just to remind, I was going to say, to remind our listeners, there was something like 315,000 applications for Goldman Sachs summer analyst roles, and their acceptance rate was less than 1%, which is not shocking. So to Jen's point, but that makes sense, right? Like going to Citadel, it's the type of thing where it's like you go to these, again, very hard to get into investment banking, sales and trading programs. And then from there, they're only taking the top of those classes. So this all makes, to me, like complete sense. But Citadel has been starting to hire directly out of undergrad. I don't think that was that common, call it 10 years ago. Definitely wasn't the case when we had started. I don't think I'd even heard of Citadel when I started at Morgan Stanley. But granted, I don't think I'd heard of Blackstone.
I don't think they didn't have a dealer. They didn't have a dealer at the time.
But even if they had a hedge fund, I had never heard of Citadel in 2006. Which is,
yeah, but that's fair. Like
you're like give it the year you.
but it's so funny. I completely forgot about this. I'd read an article earlier today that I totally forgot, and I'm so happy you just reminded me because you were like, by the way, when you think of Citadel, and I was like, oh my God, she's going to quote this article. I saw an article today that Ken Griffin, who's the founder and CEO of Citadel, bought a $45 million Stegosaurus skeleton at auction.
Oh my goodness.
So to give you a sense of how much money is floating around in this system, we're talking astronomical money. We're talking Bezos money, right? Like this guy is one of the richest people in the world.
Yeah.
So
yeah. I mean, Ken Griffin, by the way, another person who he started with converts. So yay, converts. But so sad.
Yeah. But so, I mean, I don't know what that means for kind of the future of sales and trading. I don't know how that would work from a regulatory standpoint. I really don't know what any of that would look like. But to me, that's a pretty significant shift in terms of mechanics and attitude. If just like we talked about, right? It's like, we're talking about dinosaur skeletons. We got to talk about Jeff Goldblum from Jurassic Park. Life finds a way,
nature
right?
Nature finds a way.
Yes. So again, if you, to me, as an outside observer who is by no means an expert, it does seem to me like the continued trend is with every constraint imposed in the name of increasing these capital requirements on banks, I think we're making the system less safe and we're pushing more leverage outside of what is regulated. And so it's because the regulations, I think fundamentally, and I've said this for so long, they're always so backward looking. They're aimed at solving the problem. Literally, they're aimed at solving the problem that's more than 15 years old at this point. Yeah. And they are so politically driven. Like there is so much that is done with these bank capital requirements that is there is a punitive layer to it. We're still mad at you. Like, you banks are so evil, right? It's like, okay, fine. Most of the people working at these banks hadn't even graduated college in '08 at this point. Be mad at me and Kristen if you want to be mad at some, although we didn't do anything wrong either. But at least we were on the desk at the time. Go find Dick Fold and get him off his lounge chair at the beach and go yell at him for a while. I'm not sure that this is going to be without significant unintended consequences if we're going to take sales and trading and move it outside of investment banks. And I could be totally persuaded to the opposite. And again, Citadel friends, I would love it if you could speak to this. But I'm just not sure how that makes the system any safer. I'm curious what you think.
I do think anytime you do anything to a system, it is going to have unintended consequences. I mean, looking back at 2008, I do think that there were some lessons learned. And like I said, we are going to talk about this in the podcast episode that we have coming out this Saturday with Carrie Finley, who is she actually started sort of with us. I don't know if we overlapped, but she started at Morgan Stanley, also in the CDO group. She was more ABS CDOs. And
she was in research.
And she was in research. She went on, she went to work for Third Point, which is a very well-known hedge fund, and then has since started her own investment firm. But we were talking about how I do think there were some flawed assumptions at the time, as we discussed, namely that you have a pool of assets and like you pull them together. Oh, look, the correlation is like, they're not correlated except for yes, they are. So I do think we learned some lessons. And I think that in general, regulation on the whole does tend to make things safer. But you're exactly right that whenever, there's a problem, it's like, what are the unintended consequences? And there always are unintended consequences because like you said, nature finds a way. Jeff Goldblum, like people are going to find a way to, I don't want to say get around the system, but just like to work within whatever the system is to make money, to, you have this problem, you're going to figure out a way to do it that is creative. And it's legal, but it's like there always will be unintended consequences that sometimes are worse than the problem that it solves. Sometimes it's in general, everything gets better and then there's some bad stuff that pops up. So I think it's always hard because you obviously can never run the counterfactual on things and be like, well, what if we didn't put these regulations in place? And so, but I hear you. I do think that always there are unintended consequences of things happening, whether it's little things like you're going to raise taxes in a state. And so everyone leaves your state, which like we have been seeing in some of the northeastern states, which is unfortunate. Like if you live there, because then there's less tax revenues, they have to like raise it more. Like there's just always unintended consequences to all this stuff. So I don't know.
It also brings me back to another conversation we had once where, we kind of talked about a point counterpoint of is all trading gambling, right? And I do think when you see trading through the lens of all trading activity is simply gambling, right? And gambling comes with this negative connotation, right? I think about it then, okay, well, what if we sat down to play a game of poker, right? And you said, hey, this is Texas Hold'em, right? And then you didn't like the fact that you lost money when you were at the table and you suddenly had the option to switch seats with the dealer and change the rules of the game as you went, right? The other players in the game would say, okay, well, fine, you're changing the rules. I'm going to operate with the tools that I have to still try and make money because that's what I'm doing here at this table, right? So just because you change the rules doesn't mean you're going to get the outcome that you wanted or you wish that that one player had, even if that player is like the best person in the world and they're gambling for charity. So I do think that it does depend on the lens through which you are viewing these activities and the way in which you understand that they contribute to the overall function of all economic markets.
Yeah, I mean, I was going to say that's why I think like my perspective is that not all investing is gambling, because I do think that if we look at investment as a way of creating value versus to me, like gambling is like there's a winner, there's a loser, and it's a zero sum mentality. Whereas like, again, if you're investing and the whole pie is growing, then it's not zero sum. So I guess like for in the investing case, like I see a lot of value in that. And so if you look at it from the perspective that what investment banks are doing is enabling innovation, enabling people to create businesses, create new jobs, create wealth for themselves, for other people, I think that it changes the lens. Whereas like you look at it as these evil investment bankers, these evil traders, I mean, you're going to look at everything negatively versus you look at it as these are people that are helping to create wealth, to lift up other people, to create jobs for other people. And this is the thing that I always get annoyed at when people sometimes come on our account, like, you evil people, like, da, da, da. And I'm like, dude, well, you want to look at what happens when you have a world that doesn't have efficient capital markets? Like there are third world countries like that, and people would kill to come here where we have that. So I don't know. I mean,
but not only that, Kristen, if that's the lens through which you view the world, which again, may be a totally valid lens, right? The irony that you would be like, well, the traders are the evil ones. So we're going to enact regulation that benefits the broker dealer arm of a hedge fund.
Yeah. No,
right?
I'm with you. Yeah.
Nothing more than a pure, right? You want to see how Citadel hedge fund trades, right? I mean, talk about not investing for the long term, right? Like if they're there in and out in a nanosecond, like you're lucky. That's not a blanket statement. They may hold positions for years at a time, blah, blah, blah. Again, we interviewed Ashish. Ashish likes to think not in terms of the 10 basis point move or the 1 basis point move, right? He likes to think in terms of the 100 basis point move. He is a big macro investor, but he's one or was one of many, many, many portfolio managers at the fund.
Actually, so funny. Most people don't understand what a hedge fund is. So John and I are rewatching Suits, and I'm at the part where Mike goes and becomes an investment banker, but somehow like he's an investment banker who's a venture capitalist who's buying like old industries like Gillis, and it makes absolutely no sense. Like John and I are
to be honest,
like,
Kristen,
none of this makes any sense.
That's how
And he's
everybody
like,
thinks. Laura has also said, because I told her, I was like, I need to watch Billions from the beginning, and it's like a daunting task. And she was like, I've loved that show. I will watch every second of it with you, and I will tell you what I don't understand as a layperson. And
oh,
I was
that's
like,
amazing.
that's
Love it.
amazing.
Love it.
That's really helpful to have live. So we'll
John,
see if she can actually follow through with that.
I
But
was
wouldn't
going to
that be
say,
great?
that would be amazing. But John was like, you really need to also do almost like a episode by episode of Suits and be like, this doesn't make sense. This doesn't make sense. This doesn't make sense. Just nothing made sense. Like my first deal as an investment banker and like, I'm trying to buy this thing. And it's like, that's not what bankers do. Like anyway, it was wild. But no, this was really fascinating, Jen. Thank you for talking about that, explaining it. I think it's so interesting.
And guys, this is just my take off the top of my head. If you have a different take on this, or if you think we're wrong, or you hear anything more about this, because this was like just a random one-off Bloomberg article that I read. This may be something that's been more widely discussed, and everybody knows about it, and I'm just like the last person at the party.
I don't think that's the
Who
case.
knows? But we're always really curious to get you guys' feedback. So please share your thoughts with us and let us know if you want to hear more of this kind of stuff.
Awesome. Well, yeah. And so just to reiterate, so this weekend we are going to be interviewing Carrie Finley. She's going to explain securitized products to us. She now, like we said, has an investment firm. She talks about private credit. She also, this is really, really interesting. She makes anyone who works for her sign a prenup on their carry. So we're going to get into why that is. So it's a fascinating episode and I think you're going to enjoy it. So again, thank you guys so much for being here and we will see you next time.
Bye.
Bye guys.